Welcome everyone, or welcome back if this is your second time attending FinLitCon, the series. We're so excited about today and to have Tae Kim with us. Before we get started, I just wanted to give a couple housekeeping items. First, this series is recorded, so please keep your cameras off and muted. We encourage participation in the chat. We're going to have our staff monitoring that, so feel free to ask questions or engage with each other there. We do ask that everyone be respectful with their comments and refrain from selling or promoting any products or services. A huge thank you to the FinLit team for putting this all together for us. There's a lot of work that goes into this behind the scenes, and they're a dedicated team that's passionate about this work. Please be on the lookout for additional email from them in the coming weeks about our exciting new FinLit Peer Mentor program. And please make sure to stick around until the end, as we'll be asking for your feedback with the survey. The survey is super crucial. It helps us pick new people for future events, and we make a lot of changes based on your feedback. So with that said, please join me in welcoming Tae Kim. Tae Kim is founder of Financial Tortoise, a YouTube channel focused on building wealth slowly. After paying off $105,000 in student loans in 3.5 years with his wife, he found his passion for educating others about money. He creates weekly content about personal finance, investing, and building wealth slowly to empower others with better financial literacy. In his previous life, Tae was a finance director and a captain in the U.S. Army. So welcome, Tae. With that, I will hand the reins over to you for the duration of our session.
Awesome. Thank you so much, Misty. All right, I'm so excited to be here. Let me just share my screen so that we're all looking at the same thing. All right, can someone give me a thumbs up on the chat if you can see my slides?
You can see it.
Awesome. Okay. All right, so today's presentation is titled Investing Simplified. So as Misty shared, I have a YouTube channel called Financial Tortoise, where the channel is focused on building wealth slowly. So investing is a pretty scary topic for a lot of people that's first started getting into personal finance. So we're going to demystify and simplify investing for you today. But before we get started, just a little bit about myself. Since, if you've never seen my YouTube channel, you've never heard of me, I just want to give you some context so that, you know who you're talking to, or you know who you're hearing from. So my formal bio, as Misty just alluded to, I was a former soldier, former finance director, turned into a middle-aged YouTuber. Had a midlife crisis in my late 30s and decided that I would try my luck trying to be a personal finance YouTuber. My formal education, I went to UC Irvine and UCLA, so I'm primarily from the West Coast, where I got my undergrad and graduate degree from. However, pretty boring bio. It's a pretty standard resume. I think what I want to really talk about is why I'm here today. What my real bio is, what qualifies me to be able to speak to you today. So my real bio is, I went broke at the age of 20 and again at the age of 30. I racked a bunch of credit card debt in my 20s. I lived paycheck to paycheck. I blindly bought rent-to-own furniture when I was young. I overpaid for a brand new car. I borrowed $105,000 of student debt. I invested in speculative investments, and I overpaid for actively managed funds. So I feel like we are a sum of a lot of our mistakes versus our successes. And this is what I want to kind of share with you, is that I don't consider myself like any money expert that knows anything, something that people don't know. A lot of this information is really out there on how to get better with money. I'm just a regular guy who made tons of money mistakes in my life. And my goal today is I want to help you avoid making the same mistakes that I did. So with that said, we'll get started. All right, so when you hear the word investing, what comes to mind? If you're a movie buff like me, you probably think of movies like Wall Street, Trading Places, The Big Short, The Wolf of Wall Street. Or you might be thinking of stocks like Google, Coca-Cola, Walmart, Tesla. Or if you're into alternative investing, maybe crypto like Bitcoins, commodities, or art collectibles. Or you might have heard of famous investors like Warren Buffett, Peter Lynch, Ray Dalio. Or if you're into real estate, maybe single family housing, office buildings, or condos. But you also probably heard of a lot of very confusing terms regarding investing. Terms like dividends, depreciation, amortization, beta, alpha, liabilities, equity, stocks, bonds, allocation, rebalance, annuity, capital gains. So much out there, right? When we think about the word investing, not just in Hollywood, but different types of investing and all these terms that come with it. It makes your head spin, right? Makes you want to bury your head in the sand. Well, I'm here to say, do not worry, because in today's this session here, I want to go through with you 12 simple investing lessons to help you build sustainable wealth. And when you hear the word simple with investing, a lot of you guys might be thinking, but shouldn't investing be complicated? I say no. I believe that simple investing is better, because simple investing is not only more efficient, it's effective, and I believe personally that equates to better life. Warren Buffett has said, you don't need to be a rocket scientist when it comes to investing. Investing is not a game where the guy with a 160 IQ beats the guy with 130 IQ. All right. But before we get into the nitty-gritty of investing itself, I want to kind of take a couple steps back and talk about just money in general, because I think we want to be in the right place with money before we delve into investing. And I really believe that investing starts with savings. There's this money myth that if we just make enough money, if we have big earnings, that will naturally equate to big wealth. I just need to earn more and I will become rich. However, this is not true. It's not true at all. And to highlight why this is not true, I like to present with you one of my favorite examples is Mike Tyson, once known as the baddest man on the planet. Mike Tyson, you guys probably all heard of him. He's been a heavyweight champion 6 times, and he's probably one of the most famous heavyweight boxers of our lifetime. He was so good that he could charge $30 million per fight, and it's been calculated that he probably earned close to $400 million in earnings throughout his boxing career. However, while he was excellent at making ridiculous amounts of money, he really sucked at keeping his money and growing it. Big money came with some big lifestyles. So what are some of the things that Mike Tyson spent his money on? In his 30th birthday, he spent $580,000 for a birthday party. I wish he only spent $580. He spent $580,000 for an epic 30th birthday party. He was known to have a car collection worth $6.3 million. He owned a Bentley, Lamborghini, Hummer, and many others. He once owned 3 Bengal tigers, and his food budget for these tigers alone was $200,000 annually. And he once had a bathtub made of pure gold that cost about $2.2 million. So when you look at all this lifestyle expenses that he's had, it's not a surprise that in 2003, Mike Tyson filed for bankruptcy. Income is just one part of the formula when it comes to wealth building. If you want to really build wealth, you have to manage the expense side of the formula as well. And this is something that I think a lot of people forget. That's why we have this myth that people believe if I just make enough money, if I make a lot of money, I can build wealth. But why do people have a hard time managing the expense side of the formula? Which leads to lesson number 2. That I want you to understand the Diderot effect. So for those of you guys who are hearing this effect for the first time, let me kind of explain where this came from, who this came from. So Denis Diderot, he was a 16th century French philosopher who co-founded the encyclopedia. However, despite having this fame, he was quite poor. He was so poor that when his daughter was about to get married, he couldn't even afford a dowry. However, because of his work, he had a pretty big, decent fan base. A notable fan who was Catherine the Great, the Empress of Russia at the time. So hearing his financial trouble, Catherine, she decided that she was going to buy his library for today's equivalent of 50,000 US dollars. Diderot was overjoyed, as you can guess. So what did he do? Like most people do when they come and they get a hold of money they didn't expect. He went out and bought stuff. He bought himself a new scarlet robe. However, Diderot's robe was very beautiful and was so beautiful when compared to all other things that he already owned. It seems so out of place around his regular possessions because remember, he was poor. He's been in academics most of his life, so he didn't have that much money. And this new scarlet robe it just seemed out of place. And in his own words, there was no more coordination, no more unity, no more beauty. And he went on a spending spree because he was like, hey, like the scarlet robe doesn't match what I have in the house. I need to start adding stuff so it matches my new scarlet robe. He decorated home as beautiful new furniture. He bought a new kitchen table, a new mirror, a new leather chair. And as you can guess, like our friend Mike Tyson, he became broke again. And this is what is called the Diderot effect. Essentially, simplified, it's the lifestyle inflation. So bottom line, we want to be careful of lifestyle inflation because this is something that catches all of us. Because even if you can invest like Warren Buffett, even if you can invest your money and get ridiculous amount of returns, if you're not saving your money, if you're affected by the Diderot effect and inflating your lifestyle whenever you have extra money, you'll have $0 to invest. And it doesn't matter how much returns you get, we'll end up with $0. All right, so where to learn about investing? Where is the best place to learn? So usually where people first go is the financial media, the newspaper, the internet, the TV shows dedicated to stock picking or the latest, hot mutual funds. This is where it leads to lesson number 3. Ignore the financial media. There's another money myth. We believe that financial media equals financial literacy. We turn on the TV and we see guys like Jim Cramer, the host of Mad Money, talking about what stocks to buy. You'll open up your web browser and you see articles like best stock to invest $1,000 in right now, the best stock funds to buy in 2023. And on TV shows, you see all these talking heads talking constantly about, hey, how the market is going, how the market is doing, where the market is going in the future. And we become to believe that if we watch enough financial media and financial news, we will get good with money. I mean, these guys seem to know what they're talking about, right? And if we watch enough of them, then we can learn how to invest. However, this is another false. The financial media isn't there for our benefit. They're created for their benefit. Because financial media is like any other networks out there. They're trying to get more audience. Because when they get more audience, they can sell more ads. And they can sell more ads, it brings them more money. So that's why you see them publishing content and articles that are sensational, eye-catching. Stuff like stock market predictions for 2024. Best stocks to buy now. 5 best dividend mutual funds to buy now. These are all eye-catching, right? Nobody wants to learn about the slow fund to buy, yesterday. They want to see how can I make money today. That's why they're pushing out all of these content that are very sensational because they want to get the audience and they want to get the ads and they want to get the money. Because for them, more eyeballs, it means more money. So bottom line is ignore the financial media. I mean, but there are some, decent content out there. So my recommendation is at least to be careful with it. Understand the intent of what these financial media is trying to do. And my recommendation is this. Instead of relying on financial media for our financial knowledge, read quality personal finance investing books. And here's some of my favorites. Total Money Makeover by Dave Ramsey. If you're in debt, this is a great book for paying down your debt. My wife and I read this book when we had $105,000 student loans, and this book really helped us to pay down debt. A Random Walk Down Wall Street, The Psychology of Money, The Millionaire Next Door, The Richest Man in Babylon, The Simple Path to Wealth. I think this book is really one of the best books for investing, to get started investing. I Will Teach You to Be Rich, and then The Boglehead's Guide to Investing. And I would definitely recommend you read these books, but if you also want to, a quick way to learn about some personal finance, a shameless plug, you can also go and check out my personal YouTube channel. It's called Financial Tortoise. All right, lesson number 4. So do not pick individual stocks. To highlight this point, I want to tell you a tale of 2 companies. Many, many years ago, there was a company called Blockbusters. If you grew up in the 90s or the 2000s, you know Blockbusters. At its peak in 2004, they had 9,000 stores worldwide, 84,000 employees. 65 million customers came into their store every year, and $3 billion in valuation. I mean, they were the go-to company back then. Around the same time, there was this little tiny company called Netflix. They had 0 stores because their model was DVD rental. They had whopping 264 employees, about 300,000 subscribers, and their net income in the early 2000s was negative $58,000. So the CEO of Netflix at the time, Reed Hastings, and he's still the CEO, because they were struggling, he actually went to Blockbusters and said, hey, would you guys be willing to buy us for $50 million? And Reed Hastings thought this was a great deal. Hey, we have this business model. The internet's getting bigger and bigger. Blockbusters need a presence online, and we can help you do that. For $50 million, why don't you buy us? And he spoke directly to John Antioco, the Blockbuster CEO at the time. They said no. However, it was actually worse than that. Mark Randolph, who was the first CEO of Netflix, actually wrote in his book about this experience, saying, John, not only did they say no, he was actually struggling trying not to laugh because they thought it was laughable that Netflix was worth $50 million at the time. And we all know how the rest of the story unfolded, right? Netflix today is worth $200 billion in valuation. They pretty much redefined and created the streaming industry. Well, Blockbusters filed for bankruptcy in 2010. There's only 1 store remaining right now, I believe, in Oregon. However, if any of us went back to the early 2000s where I described the peak of Blockbusters and when Netflix was just getting started, could any one of us have really predicted this in the early 2000s? Yes, if we look at a diagram like this, we see how, yes, hey, I totally see how Netflix just blew Blockbusters out of the water and Blockbuster just went bankrupt. However, if we went back to this time in period where Blockbuster was at the top of its game and Netflix was just getting started, could any of us have honestly been able to say, hey, I know Netflix was going to get big? We don't know. Hindsight is 2020. The harsh truth is that I can't pick winning individual stocks, and neither can you. There are very few people who can do that well, and even they'll admit that it's super hard to do. Because for every one Netflix, there are thousands of Blockbusters that we've never even heard of. So next time you're tempted to stock pick, ask yourself this question. Am I Warren Buffett? And if you're not, I would say keep moving on. All right, lesson number 5. Okay, so you're not going to pick individual stocks, but how about these cool investments I hear all the time? Crypto, NFTs, flipping real estates. My lesson here is be wary of cool investments. And to highlight this point, I want to tell you a tale of a flower. What comes to mind when you see this field here? Beautiful tulips, right? However, would you be surprised to know that at one time in history, these tulips were the focal point of one of the biggest asset bubble in history? That's right. In the early 17th century, around 1637, there was something called the tulip mania. They were considered one of the hottest investments of the 17th century. People were buying and selling these like hot potatoes. At one point, a single tulip bulb was sold for upwards of $750,000 in today's dollars. However, like any bubbles that go up, it crashed back down again. When speculation drove the value of tulip bulbs to the extreme, it crashed back down. Sounds familiar? Because this is, we hear of tulip mania and we think that's a one-off event. But actually, if we go through history, it happened over and over again. And actually a lot of it in pretty recent times. The Japanese asset bubble in 1989, where Nikkei 225 hit its peak in the late 1980s, and then it never recovered again. The dot-com bubble of the 2000s, where everybody was believing that if you had a .com after your company's name, I mean, people bought these stocks just because of the fact that it had a .com. Housing bubble of 2008, people bought more homes than they could afford, and then we all paid for it. And then most recently, the Bitcoin bubble, right? Shot up a couple years ago and hasn't recovered to its original height again. So the lesson regarding alternative investing or cool investments is this: if it sounds too good to be true, it probably is. So be wary of fast money. Be wary of cool investments. All right, so you might be saying, if I don't pick individual stocks and avoid cool investments, maybe I should find a money professional to help me. Sounds right? However, this leads to lesson number 6. My recommendation is be very wary of financial advisors. And let me tell you a few reasons why. There's this money myth that money professionals, people such as financial advisors, investment fund managers, investment managers are looking out for my best interest. However, this is a money myth. A lot of financial advisors are actually salespeople in disguise. Most financial advisors make money every time you buy an investment or a financial product. So you might have personally experienced it, but if you have not, there's a good chance that you go talk to a financial advisor, they're going to try to sell you a product, and because that's the primary way they make their money. The primary goal isn't to understand your financial picture and see what is most optimal in your financial situation based upon your goal. It is really to sell you financial products, because this is how they make their money and how their company makes money. Second, they have a tendency to overcomplicate money. Jack Bogle has said this: financial institutions operate a kind of reverse Occam's razor. They have a large incentive to favor the complex and costly over the simple and clean, quite the opposite of what most investors need and ought to want. So going back to the earlier point regarding a lot of financial advisors or salespeople in disguise, they have to justify what they're selling. And one of the ways they do that is by overcomplicating money. Simple solutions really don't make a lot of money for these companies. So what they have to do is they have to come up with this very intricate portfolios, intricate strategy to justify what they're selling. And 3, they're expensive. Actively managed funds, which are most often sold by financial advisors, are known to charge anywhere between 1 to 2% expense ratios. A simple index fund, which we'll discuss in a bit, normally charges expense ratio 20 to 30 times less. We'll go into a little bit more on the difference here later, so you can understand really how much more financial advisors charge. And 4, most financial advisors, when they're selling these very expensive actively managed funds, you think they would at least beat the market or do better than the market. However, they can't. Most financial advisors and investment advisors who are paid to deliver high returns than the stock market as a whole can't do it. And 5, misaligned incentives. A lot of them operate under this model called asset under management model. And the fund's primary fee is based on the size of the fund, not the performance of the fund. So this is a reason why a lot of financial advisors, when you meet with them, are trying to sell you the products, because more money they manage, more money they make. It's not really dependent upon, hey, is the performance of this fund doing really well or not? It's really how big is my fund? So you might be saying at this point, all right, I get it. Investing starts with savings. Understand the Diderot effect. Ignore the financial media. Don't pick individual stocks. Be wary of cool investments. Be wary of financial advisors. All right, Tae, I get it. But then what do I do with money? With my money? What do I invest in? Which leads to lesson number 7. My recommendation is to embrace what's called the index funds. More specifically, low-cost, broad market index funds. And what I consider the world's boringest investment. Paul Samuelson has said this: investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. And let me give you the official definition of index fund. An index fund is a type of mutual fund or an exchange traded fund, ETF, with a portfolio constructed to match or track the components of a financial market index. In English, what does this mean? An index fund does not try to pick winning stocks. It does not chase returns by constantly buying and selling. It does not try to beat the market. An index fund simply tracks the index. And some of the most popular indexes in the market, one you guys probably have heard of if you watch any financial news, is the S&P 500. And S&P 500 represents the 500 largest publicly traded companies in the US. Companies like Google, Apple, Amazon, pretty much most of the big companies you've heard of. And the second really popular index is the total market index. And this index represents all the publicly traded companies in the US. So there are about 4,000 publicly traded companies in the US currently. So S&P 500 represents the 500 largest. The total market represents all 4,000. But these two funds are actually pretty similar. So you can't go wrong with picking an index fund that tracks one or the other. An index fund investing, in a nutshell, is this. Instead of hiring an expert or spending a lot of your brain bandwidth trying to select the right stocks or mutual funds, you just invest in a good low-cost index fund that tracks the whole market. And then you move on. Simple investing. And then to be very specific, some great index fund options are these. I would say if you're invested with Vanguard, the VTSIX, which is Vanguard Total Stock Market Index Fund, this tracks the whole market. If you're invested with Fidelity, FSKAX, Fidelity Total Market Index Fund. And if you invest with Charles Schwab, SWTSX, Schwab Total Stock Market Index Fund. And if you're worried about writing all of this down, don't worry. I'll have a link at the end of the presentation where you can actually download this whole presentation, so you'll have these ready for you, so you can have these for yourself. All right, but why index funds? I said index fund is great, but you have to understand why you want to invest in index funds. And this is where I want to go through the four key principles of effective investing. Specifically, diversification, cost, simplification, and time. And then I want to go through each one of these and how it correlates with index funds. So lesson number 8, you want to diversify. You want to do effective investing, you want to diversify. As I stated earlier, it's almost impossible to pick winning stocks, as you saw from the example of Netflix and blockbusters. And funds that outperform the market are very rare or very expensive. And alternative investments like crypto, NFTs have their own share of risk. So what you want to do is embrace diversification in order to mitigate a lot of these risks. Jack Bogle, the founder of Vanguard, has said this: don't look for the needle in the haystack, just buy the whole haystack. You want to invest in as many companies as possible because you don't know what's going to be the next Netflix. So you want to buy all of them. But how, right? Today, there are approximately 4,000 publicly traded companies in the US. Netflix, Amazon, Microsoft, Apple, Tesla, Coca-Cola, Walmart, Home Depot, Johnson & Johnson, Chevron. These are just some of the biggest ones. And to individually buy each company is almost impossible to do. Just imagine you logging into your broker account and having to buy a share of Chevron, Tesla, Apple, and keeping track of each one of them. And this is where the index fund comes in. A total stock market index fund tracks all the publicly traded companies in the United States. If you were to visually show what an index fund looks like, it essentially looks like this. So you have a bit of Microsoft in here, Amazon, Google, Berkshire Hathaway, Tesla. All of these companies are all represented by a single index fund. A broad market index fund helps you to diversify your investments by investing in the whole market. So first principle, checked. Index fund is one of the most diversified investments you can make. All right, lesson number 9, cost. Let's talk about why costs matter. And in order to understand costs, I want you to learn this term called expense ratio, because this is one of the most common terms related to cost when it comes to mutual fund or ETF industry. Expense ratio is the cost of owning a mutual fund or an ETF. An investment firm charges expense ratio to cover their admin and other operating expenses. So if you're investing $10,000 into one of these investment firms, they will charge you an expense ratio because there's a cost to them for administrating and operating that fund. And actively managed funds are known to charge somewhere between 1 to 2% expense ratio. What does this look like? If you have $10,000 invested in an actively managed fund, you're paying between $100 to $200 annually for a fund manager to manage that money for you. So $10,000 invested, they charge me 2%. That's $200 I'm paying the fund manager. Let's compare that to an index fund. A Vanguard Total Stock Market Index Fund, aka VTSAX, has an expense ratio of 0.04%. This comes out to $4 for every $10,000 invested. So active managed fund, they charge 2%, $200. Index fund, $4. Actively managed funds are 25 times more expensive, thus the importance of looking at index funds. However, that's not the worst. When we compound it over time, we see the real cost. So let's do some math here. So let's say that an index fund that charges 0.04% expense ratio, you're going to invest $10,000 and you invest for 30 years at 8% return in the market. After 30 years, your $10,000 would have become $99,514. Pretty good. In 30 years, your $10,000, you didn't invest any extra money. It became almost $100,000. The cost of fees, the cost that Vanguard charged or the index fund manager charged to administrate that fund for you is about $1,000. Not a small amount, but it's not too bad compared to the fact that your fund appreciated to $99,000. Now let's take a look at an actively managed fund. Everything is the same, 10%, 30 or 8%, but now they're going to charge you 2%, what we saw earlier, right? That $200 for your $10,000 annually. When you compound it over 30 years, what do you think your $10,000 has become when they're taking out 2% every year? It's not $99,000. It's only $57,000, and that's because that $200 that they're taking out, compounded over time, is $43,000 that they took out. This difference between 2% and 0.04%, the 1.96% additional expense ratio, costs you $42,000 when compounded over 30 years. This is why cost matters so much. And index funds, in the second principle, they're cheap. So that's another principle checked off. All right, lesson number 10. So simplify, principle number 3. So we want to simplify our investment strategy as much as possible. And I want to share with you a few reasons why. 1, you understand what you're invested in. So when you're invested in, let's say, a portfolio of a lot of different things, you have some money in Bitcoin, some crude oil, you bought some Apple stocks, you have some money in banana shares, you have some money in France, different currencies, you bought some Tesla, you bought some commodities, and you have some money in cash. When someone asks you, hey, what are you invested in? It's confusing, right? I got my money here and there. I think I have some in Tesla, some in Apple. Not sure how it's all doing though. Whereas when you have your money in a simple index fund, there's only one fund to keep track of, a total stock market index fund. I know where my money is. When you simplify your investing strategy, you understand what you're invested in. Second, the reason why you want to simplify your investing strategy, you stay committed to your investing strategy. So going back to our complex portfolio. Now, what steps do I take going forward? You have a lot of different options ahead of you, right? You have money that's invested in Apple. Should I put more money in Apple? I have money in Tesla. Should I put more money in Tesla? I have some money in France. Should I put more money in France? Should I put more money in Bitcoins? You're pulled in multiple different directions. Whereas if you are investing in a simple index fund, there's only one way to go. You invest more into the market. It's already diversified. It already has minimal cost. So you just put more into the index fund. And 3, this is my personal favorite. You save so much time. No time wasted watching financial news. No time wasted researching new investments. And no time wasted stressing out about FOMO. What am I missing out on? Are there other investments that I should be looking into right now? No, you set it and you forget it. And I personally believe that when it comes to investing, we don't live to invest. There's some people that love investing. That's great for them. But for me personally, we don't live to invest. We invest so we can live out our life. Despite being a personal finance YouTuber, I actually don't spend that much time looking at my personal investments. I pretty much set it into an index fund and forget about it because I'd rather spend my time with my family, with my wife, coaching my son's soccer team, and making YouTube videos. This is what I love spending my time on, not looking at a bunch of different investment options. And investing doesn't get any simpler than the broad market index fund. So index fund, simple. Third principle, check. However, it's not enough to invest in low cost, broad market index fund just because it's diversified, cheap, and simple. We have to add another ingredient to really grow our wealth, which is time. And this is lesson number 11. We want to play the long game. This really is a secret ingredient to building our wealth. And Warren Buffett has said, even in his own Berkshire Hathaway portfolio, our favorite holding period is forever. So to give you an example of how much time plays into building our wealth, let's play a quick game. Let's say I give you an option. I say, hey, I'm going to give you $1 million today. It's a lot of money. Or I'll give you this magic penny that doubles every day for the next 30 days. So this penny will become 1 cent today, but will become 2 cents tomorrow, 4 cents and 8 cents, and so forth. What would you choose? What would most people choose? Would you choose $1 million? In 30 days, that $1 million is still $1 million. And you're thinking, unless you do the actual math, how much could 1 cent be in 30 days, right? It's, maybe a few $100s. Would you be surprised to know that that 1 penny that doubles every day would be $5 million, over $5 million in 30 days? How could this be? Let's look at the day by day. So after 15 days, it hasn't done much. $163, nothing to write home about. But if you see here, at day 25, that $163 became $167,000 in a matter of 10 days. A few days later, day 28 is $1.3 million. It went from $100 to $100,000 to $1 million. In day 30, $5.3 million. So this really is the power of compounding. And to get even wilder, let's stretch it out 5 more days and see where it goes from there. Day 30, 5.4 million. Day 31, 10 million. 32, 22 million. 33, 43 million. 34, 89 million. And day 35, whopping $172 million. And we started with 1 penny, and all we did was stretch it out 35 days. I know what you're thinking, but Tae, a penny that doubles every day does not exist, and I know that. So let's do a real world example. I'm going to take an index fund, a real life index fund, and show you what compounding can do for our money. So VTSIX that I mentioned earlier, a Vanguard total stock market index fund that invests in the whole market, all 4,000 companies. If we were to go back to year 2000, 24 years ago, it had an average annual return of around 7.9%, close to 8% annually. So then that means, over time, if you invested your money in 2000, it would have grown on average about 8% per year. So you might be thinking, hey, if I invested $10,000 in year 2000 into a broad market index fund like VTSIX, how much would it be today? I mean, could it really be that much? Maybe it growing 8%, it's not doubling like that magic penny. Could it be $15,000, $20,000, or maybe a whopping $25,000? That would be pretty crazy, right? 8% a year. However, It's actually $62,000. That $10,000, you didn't put any more money in. All it did was grow like the market, and then it's now 6 times its original investment. This really is the power of time, and why investors like Warren Buffett constantly hammer at it is, you gotta give investment enough time for it to appreciate and grow. And Albert Einstein has said this: compound interest is the most powerful force in the universe. So to summarize everything I'm talking about regarding simple investing, the simple investing strategy is this: invest in a low-cost, broad market index fund and hold it for as long as possible. That's it. That's the simplest investment strategy you can take. And you can pick any one of these funds, and there's tons out there that you can also look at. But the key is look for broad market, low-cost index funds. And again, I'll have these slides for you guys that you can download. I'll have a link at the end of this presentation where you can go and download it, so you don't have to be writing these down. But we're not done yet. I want to share with you one more lesson to kind of hammer this point. Lesson number 12, embrace enough. And I want to tell you a tale of 2 men to hammer this point. So Kurt Vonnegut, the author of Slaughterhouse-Five, was once at a party with his friend, Joseph Heller, the author of Catch-22. And Kurt said to Joseph, "Joe, how does it make you feel to know that our host only yesterday may have made more money than your novel Catch-22 has earned in his entire history?" These are writers, so they don't have a lot of money, and they were at a billionaire's home. So Kurt was, in essence, making fun of Joseph. All the work that you did into Catch-22 doesn't really matter, right? This billionaire made more money in one day than you did your whole lifetime. But you know what Joseph said to Kurt? He said, "I got something he can never have, the knowledge that I've got enough." Most people get into financial trouble because they haven't defined their enough. We overspend, we stay hooked on financial news, we buy and trade individual stocks, we get sucked into sexy investments, and we seek out hotshot financial advisors, all because we haven't identified our enough. So let's learn to define our enough, follow a simple investing strategy, and enjoy life. And here are the 12 lessons in one page. And as I promised, if you go to this link, I'll leave it on the screen for a little bit. It's essentially my website, financialtortoise.com/SNHU-Investing Simplify 2024. You can download this whole PowerPoint presentation for free. All right.
Okay, that was amazing. Are you available for some Q&A? We've got lots of questions for you.
Yes.
Okay, so let's start with this one from Jennifer. Is there a minimum that you have to invest in an index fund?
So it depends on the investment firm. So I would say Vanguard is probably the highest. They have a $3,000 minimum. However, if you were to invest in something called ETF, which is essentially the same thing, there's a zero minimum. And Fidelity has no minimum, and Charles Schwab, I believe, have $1,000 minimum. So there's, if you want to invest, there's options where you don't have to put any money in. I mean, you can literally start with $1, yeah, if you want it.
Okay. Would you suggest whole life insurance as an investment?
No. So I think there's very, very, very tiny situations where it could work, but for majority of people, I would say separate your insurance from your investment. So whole life, where they package it as, hey, this is your regular insurance expires, your regular life regular life insurance, like a term life insurance, expires. However, a whole life insurance, a whole life does not expire. However, the cost on a lot of these products are pretty ridiculous, and then the investments itself, what I talked about expense ratios earlier, are quite expensive as well. So I would say, if you want to simplify things, buy term life insurance. You can buy it if you're young and healthy. If you're a 30-year-old young and healthy, you should be able to buy $1 million term life insurance for 20 years for like $30, and then put everything else in your investments. Keep those two separate.
Okay, we have a question hoping that you can expand on speculation versus speculative market, mainly referring to investing. Since we can't predict the market, it is speculative when we make guesses of what investments will go better than others?
Right. So there's speculation. I mean, the term itself is we're trying to predict what the future is going to do. So the bottom, like this is where diversification is very important because we don't know even what the market is going to do. However, there's long-term trends that we are trusting. So the US stock market as a whole, if you stretch back the last 50 to 100 years, they had downs. However, consistently, it's appreciated by 8 to 10%, sometimes 12%. So that's the model that we're believing in, general, US stock market as a whole. So this is where, in order to mitigate, speculation, you want to diversify as much as possible. But I would caution against trying to predict what a specific company is going to do, or even a specific industry is going to do, a group of companies. Like, it's really hard to know. Like, people talk about AI, so I'm going to invest in all these AI companies. We really don't know. So, but as a US economy as a whole, US companies as a whole, I feel like there's going to be an AI company that will do well. So I'm just going to buy all of them by investing in an index fund.
Good advice. How do you know when to sell an index fund?
So it depends on why you're selling it. So if you are, so index fund is a very long-term investment. So it's best geared towards like retirement. So I'm planning to stay in the market for the next 20, 30 years. If you're looking for like a short-term, hey, I'm saving money to buy a house, index fund, I wouldn't recommend it just because you don't know where the market's going to be in 5 years, and we don't even know where it's going to be in 10 years. So yeah, like I would say selling it in retirement.
Okay. Yeah. This is kind of similar, but if you had money in stocks now, like Tesla, Apple, would you pull it out and put it in an index instead?
I would say it depends on the amount, because there's capital gains tax you get hit by selling. So I think if you want to move to an index fund strategy because you don't want to be so tied to a single company, then yes, I would sell. However, I would be careful about how much. If it's a lot of money, like, I've seen people who have like $100,000 in Tesla, like you sell that, you're going to have to pay that tax that year. So what they try to do is spread it out across multiple years. So then they're recognizing just small amounts. So they're minimizing the taxes they have to pay.
That's great. This is the most questions we've ever gotten. So like rapid fire in here. Is putting money into a Roth IRA similar to putting money into an index fund?
Yeah. So the way to think about Roth and index, so Roth is it's a tax code. So it's it's an account that is in a way authorized by the government to say any money that grows within a Roth account will grow tax-free and you can withdraw tax-free. What you decide to put inside a Roth, that's the fund, is different from the Roth account. So you put the index fund into a Roth account that is sheltered by the tax code. So then those two work together, but they're two separate things.
So piggybacking on another question we just talked about, what would you recommend for investment options for somebody who is looking to buy a house in the near future?
Yes. So like I said, index fund is a long-term investment. You don't want to be saying, so this is kind of speculation. I'm going to put money in the market and then in 5 years. So I would say if it's beyond 10 years, I think index fund is a good option. Less than 10 years, I would look at maybe CDs or savings account with currently right now with the higher interest rates, because those are a lot more predictable.
Okay. Miranda asks, would you recommend selling company stock while trying to get out of debt? And then after that, keep cashing it out and investing in a Roth or mutual fund?
Yeah, so I wouldn't sell investments if you have right now in order to pay down debt. So I talked about that concept of time. So if your money is in the market already, you want to keep that in there as long as possible. And I would try to look at your budget, your current expenses, and try to squeeze out as much as possible from there in order to pay down debt.
Okay. Grace asked, how can you manage paying off debt and also still investing in your future so you're not focusing too much on one and playing catch up on the other?
Yeah, I mean, that's a hard question, and it's very individual dependent. I would say look at the interest rate of the debt that you're trying to pay down. So I would say if there are high interest debts like credit card, and some student loans, if they're like close to 10%, I would say you want to try to prioritize paying down those as soon as possible, and then do investing. But if you have debt that is a little bit lower interest, let's say lower than 5%, I would say that can come after you've put a lot of your money into the market already.
Okay. Karen asked, what's your best recommendation for a 50-year-old who has a good 401k but wants to invest more?
Yeah, so I would look at, so when it comes to investing for retirement, you always want to try to prioritize tax advantage accounts. So if you have a 401k, that's great. See if you can open up a Roth IRA account, or if you have, let's say, a high deductible health plan, then maybe an HSA as well. I have very specific, some of these questions are very specific. I do have videos on the channel that you can look up that actually kind of goes through some of these orders. So
that's great. And we're going to share out all this information in the recording. So yeah, definitely recommend checking out Tae's site. Here's a question. Do you recommend any apps for managing these funds?
Yeah, so there's a couple free ones out there. So each company that you invest in, like Vanguard has their own app, Fidelity has their own app. So you can manage your money through those apps. If you're looking for a account aggregator, so like for myself, I have money in Vanguard. I also have money in Fidelity, but I kind of want to see them all in one place. Empower, EMPOWER, is a good free app that aggregates all of this for you. And then for like budgeting, or if you just want to kind of see all your expenses and all the investments one place, one that I personally like that you have to pay for is Monarch Money. It's like $99 a year, but they're like, I think of all the apps I tried, they're probably one of the better ones of the ones you have to pay for. But if you want to start with free, Empower is a good option.
Fabulous. Well, thank you so much, Tae. I've learned a lot. I'm making notes, and I'm sure all of our students and staff are doing the same. So thank you for being here. We're going to go ahead and put up the survey screen so we can capture everyone's feedback. If you all could please scan the QR code with your phones and complete the survey, it would be greatly appreciated. We'll also provide the link in the chat. And an email is going to go out to every single person who registered for this on February 9th. So be on the lookout for that. Thank you all. We appreciate it. We'll just hold this survey screen up for a bit.